Hey everyone, and welcome to the ASPE versus IFRS review. The time is now approximately 8:02 p.m. Eastern Standard Time. This is Mike Katzman. Welcome to this webinar. We're going to be covering a number of different topics today. There's going to be a lot of information covered. We'll also apply directly to a case. Just want to first get a sense, are you able to see the presentation? Can you hear it? If the audio quality is okay, and if you can see the video, kindly let me know. Feel free to also say hello. It's been a while since our last webinar last week when we were looking at the CFE Live series. Those were the last webinars that we've done. Now we're going to change gears and start focusing on more detailed topics going forward, okay? And this will also set kind of, the stage for some of the future webinars that we'll be running throughout the summer. Now, please note there's some new webinars that have been uploaded today. That will be running sometime tomorrow. We should be able to upload more, so we intend to bring it up to about mid-October, which is wonderful. So perfect. Welcome. Okay, so glad to have you all here. I'm your session leader for today. This is Mike Katzman. I'm the course director at PEP Formula. In the past, I've been a comprehensive marker and independent consultant as part of the National Marking Center for CPA Canada. I've also had quite a bit of experience with different, marking organizations, educational, kind of related organizations, with York University and with my old firm at E&Y. Okay. Why PEP Formula? We provide a supplementary personalized training program for students going through CPA PEP, and we pair students with CPA markers on a one-to-one basis. Also certified as a designated post-secondary educational institution. Had an 89% pass rate in 2014. We're not allowed to collect pass rates past 2014. I get this question a lot. I wish we could. We can't. And in between 2015 up until now, we've been the largest and most trusted CPA prep program in Canada based on site traffic. So I do appreciate all of you attending. You've made all of this possible. So would just like to kind of quickly see for anyone experiencing audio video issues, please use Google Chrome and refresh. Okay, we can't have like 100 people saying, hey, we can't watch stuff. Okay, you have to use Google Chrome. That's going to provide you with the best experience possible to see this webinar, and just refresh your screen. Okay, but we have to get started, so we'll just kind of quickly kind of move forward from here. Okay. So what I like to always start off by doing is just covering a quick legal disclaimer. The copyright of the handbook standards belongs to CPA Canada and other provincial bodies. Strictly, the interpretations below are my own personal opinion, and all rights are reserved. I'll be kind of walking you through a few ways to operationalize, and also understand some of the handbook criteria, which is a little different. Also, the opinions are not to be relied upon. They're provided for illustrative or educational purposes, and it's not meant to be like accounting or legal advice. You can't take this and then apply it and say, hey, I know legal stuff and I know accounting based on this one, webinar. And last but not least, PEP Formula is not affiliated or related to any of the CPA bodies. We are completely independent. Always let's start off. So I'll explain how we're going to do this webinar, okay? I'll explain kind of the format of what this is going to be like. We're going to go through a number of different topics, okay? And all these specific topics will focus on kind of the key most tested ASPE versus IFRS subjects. Okay, so what I've done is we've analyzed a number of previous exams, approximately a decade worth, okay? 10 years worth of exams seems to produce a lot of interesting information, and we always seem to hit the right topics. really because these are the topics that matter within accounting. So a lot of what we talk about is specifically the topics that you should know about, okay? And we're going to do a quick technical review. I'll also give you a really kind of, easy way to remember some of the ideas that we're going to talk about. And then in addition to all of that, we'll also do a quick case at the end, okay? So I'll kind of walk you through and we'll talk and kind of show you that these are real life items, that you kind of need to know for the exam, okay? So this is not just some random stuff. This is actually something that can appear as part of your exam. And please note, for anyone who just wrote Core 1, I got a number of emails saying that this exact webinar run the past time, the last time that we ran, almost nailed pretty much every one of the issues on the most recent Core 1 exam. And really, again, I'm not doing this, I'm not here to guess the future. All I'm simply doing is just analyzing, the frequency of testing. And I mean, it's really no big secret that these are the most important areas within accounting. So they appear to be tested pretty frequently. Okay. So here's the first one. In my opinion, this is the most important one. You'll notice that I kind of rank things in order of importance. Okay. The way that they're important to me. So that's really what you'll see here. Okay. Let's move on to revenue recognition. So the first thing that you want to ask yourself when you are looking at revenue recognition is you want to separate out the concept of goods versus services. That's really the first question that you have to ask yourself. Am I selling a good or am I selling a service? Now, there's instances where it could be both. There's instances where you can have both a good and a service. Most of you currently in your pocket, you're probably holding a cell phone. That cell phone probably came with a contract. So that's a perfect example of what is a good tied with a service. And also what's even more interesting is you probably did not pay the fair market value for that specific cell phone. You probably got it subsidized, okay, by the carrier, right? So for example, your Bell, your Rogers, your Fido, whichever your carrier, your favorite carrier is, they've probably subsidized, your phone. So what accounting standards tell you is you first need to identify what is a good and what is a service and separate them out, okay? When you separate them out, it's easy to account for them. And you also have to allocate the fair market value to both areas. So once you've actually allocated the fair market value, you now have to somehow recognize the revenue. So when you're specifically talking about the good portion, which in this case is that phone, right? Just simple example to explain. You really come up with two standards, ASPE 3400 and then IFRS IS 18. ASPE tells us that we need to look for performance being achieved and that collection is reasonably assured. Okay, performance generally looks at risks and rewards of ownership. And we generally look for a couple of key signs from a case fact perspective or even from a multiple choice that all significant acts have been completed and there's no continuing involvement. Now, what does that mean from a goods perspective? All significant acts completed. A significant act could be like the delivery of something, okay? That's generally how you can, remember. Also, a significant act could be something where you don't have to do anything later on to service the good. Like, for example, you are not providing some sort of a warranty above and beyond like the, whatever is offered as part of the actual cell phone. Like the warranty might be offered, but it might be offered from a third party, from the actual manufacturer. So you as the retailer, like you as the carrier, you have no continuing involvement, assuming that you don't, contractually have to do that, right? So that's kind of a really good way of, simplifying a very complex standard and then applying it to something that you kind of know, because you probably all have cell phones sitting in like in your pocket or in your purse or wherever, okay? Next is we need to look for reasonable assurance regarding measurement. So measurement is how much you paid. What is that price? Is it fixed? Is it determinable? And basically, you'd want to look for some sort of an invoice. Now, a fancy, invoice is kind of like a fancy word that people use. Invoice means, well, it could be like a formal whatever invoice. Now, what's also an invoice is like a receipt. If you get a receipt from, the purchaser, the business that you've purchased from, well, in that case, you probably know how much the consideration is, which means like you probably know how much the price of that phone was. Therefore, if you can, transfer all risks and rewards, and you have no, uncertainty relating to the measurement of the consideration, basically the price, and the extent of the return. So, returns are very unlikely. In that case, ultimately performance is achieved, and therefore you can recognize revenue. Okay, so simple. 3400 tells you basically look for these two things. IFRS is generally similar, okay, but it's not as specific. It doesn't give us as much kind of meat to work with. It's much more theoretical in nature, and we kind of look for more like signs of things going wrong. So, for example, seller has transferred all risks and rewards of ownership, right? That's kind of like the same idea, but then there's no real explanation. But you can use the same explanation from ASPE. Also, there's no continuing involvement or control over the goods. Same idea, right? So same idea. Amount of revenue can be measured reliably, right? So instead of it being like the seller's price being fixed and determinable, right? Based on the performance, we actually just have to, reliably measure. It doesn't have to be fixed. So that's a slight difference, but it could also be wording, so it's not necessarily something that's different, but you kind of just have to know that. Also, it's probable that the economic benefits will flow to the entity. Now, we're almost assuming this, right? Like, we're almost assuming that if we've already delivered something, if all significant acts have been completed, that we get some sort of economic benefit. And economic benefit could just be cash, right? So that we are able to collect cash to it. So what this introduces is kind of like the concept of collections as part of IFRS that wasn't really present as part of as part of ASPE. And lastly, costs incurred or to be incurred can be measured reliably. It's similar to what we're kind of talking about from a revenue perspective. However, there is a specific point for that. So I would say in practice, these standards are pretty convergent, and you can actually use these almost interchangeably to account for revenue. Now, from a services perspective, here's where we kind of come up with some serious changes and some serious differences. ASPE says that we can use either the percentage of completion method to account for services, or we use the completed contract method. Okay, so basically, in general, we use the percentage of completion. That's almost like the preferred method. However, when performance exists of a single act or the extent of progress cannot be measured, use the completed contract method. Okay, so let me explain what that means from performance consisting of a single act. Let's say under ASPE, you own a construction company, and then your client, is buying construction services from you, and it has the ability to reject the house that they are, kind of buying from a building perspective. And let's say that, they have the ability to kind of say, sorry, general contractor, I'm not going to accept the house that you've built for me. If they have the ability, or the opportunity to actually do this, in this case, you probably can't argue that performance, can be measured, right? So in this case, if there's some sort of an indication that there is one single act that's much more important than anything else, then at that point you would probably need to use the completed contract method. Okay, and someone just added as a comment, and I kind of agree. IFRS is much broader in scope or ASPE. Actually, I'm not sure whether that's a question or not. It kind of reads like a question, but I don't quite like it's really not a complete question. So if you want to ask this again, KJ, yeah, I apologize. You don't really have your name here, so I can't really help you. But if you want to restate your question, would be happy to help. IS 18 only allows the percentage of completion method. Okay, so basically, in general, we strictly do not allow the completed contract method. Okay, so we're never going to really use that method. It doesn't exist under IFRS. Now, generally speaking, when the outcome of a contract cannot be measured reliably, revenue can only be recognized to the extent of the expenses. So, we want to look for recoverability of expenses, and we want to determine whether we can actually recover on some of the previous expenses associated with, basically with our own kind of acquisition of these assets. And if we can, recognize the expenses and we can measure what they are, then we would be able to actually use that as part of our percentage of completion method. So in practice, the outcome can be measured reliably if the outcome can be measured reliably, you use the stage of completion or percentage of a completion method. So when is performance not achieved? We further look at the standards to kind of determine what are specific areas that are highlighted directly by the standards. You'll notice that ASPE gives a few examples. IFRS doesn't really. ASPE talks about 5 specific examples that I wanted to mention because they appear on exams a lot. The first one is customer acceptance, right? So this is the one that we talked about earlier. You are kind of this like construction company, and then, someone is buying something from you. Well, how do you know whether you can accept it or not? Well, customer acceptance really relies on you giving the green light and saying, yes, I accept this. If there's a customer acceptance provision, technically speaking, a customer has the ability to reject, which is why you can't recognize revenue, because there's a risk that the client will actually reject, right? So even if you recognize revenue, it doesn't mean that it's ever going to be truly recognized. Does that make sense? Next, layaway sales. So we look for a few other ideas here. Layaway sales. What layaways mean, and actually a lot of folks are not really aware of what these mean, of what this kind of actually is or what this means. Layaway implies that we're dealing with a situation where you are making partial payments towards the acquisition of something, and you are basically slowly paying off the good. And once you've paid the final payment, then you can, get to collect that specific good. Well, because the person that you were, engaging in these layaway sales with ultimately has possession, performance has not been achieved, mainly because risks and rewards have not been transferred. Does that make sense? So because of that reason, we can't really assume that that's the case. Next, upfront fees. Upfront fees is yet another example of this. Upfront fees are really interesting because just because you get some sort of a retainer, it doesn't mean from an ASPE perspective that you get to recognize the revenue, because you may have not really achieved or done anything to warrant, the specific fee. Next, bill and hold arrangements. If we're dealing with anything that might relate to bill and holds, when we are looking at a situation like this, bill and hold arrangements might be something like, you buying something today, but then the actual delivery happens later at your request. When this is the case, chances are there is an opportunity for spoilage potentially. And again, there's no performance. Next, unpredictable or unusual rates of return. If you allow someone to return something for life, okay, that would be an unpredictable or unusual rate of return, right? So in that case, you'd probably want to decide whether that's something that that would be reasonable or not from that context. Okay. So yeah, just wanted to really explain that. And from an IFRS context, there's really a few examples. Really one of them is consignment sales. Consignment sales are things that happen a lot in, say, the jewelry world. As part of the jewelry world, we might be in like in a situation where a manufacturer lends equipment or stuff to a retailer, and that retailer has the ability to sell it. When the retailer sells it, then the manufacturer gets paid. Okay? So that's really kind of the whole idea behind consignment sales, and which is why performance is not being met. Any questions up to this point? Any questions up to this point? Just want to make sure that no one has any specific questions. If you're experiencing issues with video, and some people are saying that they're experiencing some issues with video, feel free to just refresh your screens. It's probably something local, so feel free to just, refresh, and you'll come right back into the screen. Is anyone else experiencing issues with video quality? Let me know. Mitzi asks, what about non-refundable fees? That's an interesting question. So non-refundable fees doesn't really mean anything from an accounting context. And let me explain kind of what I mean by this. So from an accounting context, you need to understand the lifetime value of that specific customer and the idea of how long you believe that customer will be with you. So if it's some sort of so a lot of gym memberships charge initiation fees that may be quote unquote non-refundable. But if you know that someone on average stays with you for 2 years, ASPE actually requires you to kind of say, well, because you expect that person to be with you for an X number of years, because of that reason, they are no longer, non-refundable, and we would actually have to defer and amortize. Okay, we would have actually have to amortize everything. Okay, the other question is, for layaway sales, performance is not met, but the buyer paid a few months installment. How do you recognize revenue? So the whole point, Sita, is, you don't recognize that revenue, right? You don't recognize that revenue. That's really the whole point. So the installment payments that are paid, because the product has not been delivered, you can't recognize revenue simply because you still hold title. Okay, you hold that title. Okay, so multiple deliverables. How do you watch out for things that have multiple deliverables as part of a case? So what are multiple deliverables? So when a single act has multiple components, for example, the like our example from before, the phone being sold with a contract, or a washing machine sold with with warranty, for example, a dishwasher sold with a warranty component, right, with a service contract. The revenue recognition criteria are to be applied to all the components separately. Okay, so that's the same on like under both ASPE and IFRS. You have to apply them separately if it better reflects the substance of the actual transaction. So what we mean by that is, if we feel like it more accurately reflects the substance, then we have to separate it out. In a situation with warranty and a machine, well, those would be two separate products, which means that you definitely need to treat them completely separately. But in a situation like this, there might be some examples where it might be completely integrated. So you kind of have to just think about it on what that might be. Also, they should reasonably reflect selling prices that would be received as part of a standalone transaction, which basically tells you to use fair values or fair market values of the best approximation of prices, right? Or this residual method when you're trying to account. The other way that revenue recognition is tested pretty often is part of something like this, a principal versus agent discussion. So you might have a situation where you might be collecting a commission on a sale, a really simple example for me to just kind of walk you through here would be the idea of selling a house. Okay, let's say that a builder is building a number of houses on a street, and then there's a real estate agent that's selling the houses, and they're making a 2% commission on each house sold. Okay, let's say 1% commission, just for simplicity, just to really keep things simple. Okay, so let's say a house costs $100,000, right? Where in this case, the agent makes $1,000 for each sale. Okay, does that make sense? Like, very simple kind of analogy here. What you might have to understand, first of all, is who is the agent and who is the principal. So factors that support principal, aka recording gross, would be the entity has the primary responsibility for providing the good or service. They have inventory risk, they have latitude in establishing prices, and they bear credit risk. So these are examples for what might be kind of supporting, recording gross. And really, recording gross means recording the entire $100,000 amount and then incurring the expenses away from that. So you would, credit the $1,000 paid to the agent. Now, what happens if you're the agent, right? Think of it from that context. What happens if you're the agent? What happens if you are strictly receiving $1,000 for that sale? And to me, this is like a personal pet peeve of mine. And I've talked about this in some of my previous webinars. If this is the first kind of time that you've heard this, this is a really interesting way to remember this. But you might see some billboards on the streets sometimes where real estate agents might write something like, "I have sold $1 billion, the worth of real estate." And to me, that that is misleading from a context of ASPE or IFRS, because that person really is not responsible for the gross amount of the assets. They never had inventory risk. They never had latitude in establishing prices like that builder, right? They strictly received a commission. Not that that's not something that's, like, I'm not going to say that there's something wrong with them doing that from a marketing context, but strictly from an accounting perspective, they would be strictly an agent in that case, okay? So basically, that would be someone who would earn strictly the commission. So they can't write, 100 minus the 99 equals 1. Okay. Any questions on revenue before we move on to intangibles? I know revenue took a long time, okay? Revenue is supposed to take a long time. Revenue is kind of the point of accounting. And the point of accounting is for you to talk about numbers. And numbers are often tied to revenue. So this is something that I say is critical from that perspective. Okay. All right. So intangibles and goodwill. To me, this is probably the second most important topic. I think it's very highly tested. I think there's a lot of information that's usually covered as part of this. And it's something that I kind of, is one of my most favorite topics for me to consider. So, it's something really that I highly recommend for you to just try to understand very well. And because of the conceptual nature of, this idea, this notion of intangible assets, you kind of just have to really, get a feel for it, basically. Okay, so intangibles really looks at a number of different things. ASPE looks at, the basic definition of what is an intangible. It would be a non-monetary asset without physical substance that meets the following criteria. Can you identify it separately? Is it capable of being separated or divided from the entity sold, rented, licensed, etc.? Okay, so basically, does it have value on a standalone basis? You must also be able to control it. So you must be able to obtain access to the benefits and restrict others to such benefits, okay? Normally this stems from the legal right, the copyright, the patents, or like employment contracts, right? A really simple way of explaining this is basically like a patent, okay? That's probably the, really the most simple way possible. And last but not least, okay, last but not least, in order for you to call something an intangible, remember, folks, intangibles are assets. They're supposed to be assets. So if something is truly an asset, it must provide you future economic benefit. If you don't believe, okay, if you don't believe that it, will ever provide you with future economic benefit, you have to impair it. You have to depreciate it. You have to amortize it, right? The whole idea of an asset is you feel like you're holding it because in the future it will provide you with a future economic benefit. The first two, I think, are pretty obvious. They're more like legal terms. The last part is more like, what can you really identify as part of kind of, the overall process. Now, when do you recognize it? ASPE says it can be recognized when it meets the definition of an intangible asset. So then we look for the recognition, criteria. So again, we first see whether it meets the idea of a non-monetary asset. Then we look for the recognition criteria, that it's probable that the future benefits will flow to the entity. And then, we're trying to identify which costs might relate and might reflect the overall value of that intangible. So here's where there's a pretty significant difference between 3064 and IAS 38. 3064 says that costs incurred as part of a research phase must be expensed, okay? And the entity must make an accounting policy choice to either expense or capitalize costs incurred in the development stage. The policy must be applied consistently to all internally generated assets. So what that means is you can't have one asset that's recorded in a certain way and then another one that's not recorded that way, okay? That just won't fly. That's not allowed. And the way that you determine, specifically even from a case writing perspective, is by looking for the following 6 areas: technical feasibility, intention to complete, ability to sell, how the asset will generate probable economic future benefits, availability of adequate resources to complete the development, and then the ability to measure the expenses as overall associated with it. Okay, so once you kind of have that, then you can capitalize these costs. Now remember, you have a choice under ASPE: expense or capitalize for your kind of overall development stage. What IFRS says, you must expense the research phase, you must capitalize the development stage, assuming that you can meet the actual criteria as well. But the choice for development costs is no longer available. You must capitalize. Okay, so that is one major distinction. Remember this from a case perspective, I think this is really critical. If there's any startup costs, training costs, advertising and promo costs, these are all period expenses, okay? They don't really help you in the future. You might argue that, but you are required, as per the standards, to expense them immediately. Also, relocating or reorganizing part or all of an entity, always expense. How do you recognize internally generated goodwill? So first of all, I get a lot of questions about what is internally generated goodwill. What is the concept of internally generated, goodwill? How is it different than regular or other intangibles? So here's something that I kind of just want to explain. Internally generated goodwill, just to simplify and explain what that might be, is often called sweat equity. Okay? So if you don't pay someone a salary, but they work for you to develop a product, that's sweat equity. That's ultimately internally generated goodwill. Now, it's kind of this strange concept that you don't really know how to account for this stuff, but basically any costs including that would be directly attributable to create, produce, and prepare an asset to be capable of operating, right, would be, and by the way, this can be either employee salaries, wages, or their benefits, fees to register a legal right, and then the amortization of patents specifically used or licenses. If you use one license to, say, create another license, right? Like, that's kind of the whole idea here. Along with interest costs. But remember, ASPE has this weird thing with accounting policy. A specific accounting policy that forces either the capitalization policy of interest or not. So it's an option on as part of ASPE. But we'll talk about this also in a second. But in that case, it would be directly included as part of the cost of your intangibles. I'm getting a quick question here. Mike, can you explain with examples the policy must be applied to all internally generated assets? And I think you're specifically asking about this. So I think what this is trying to say is that it must be applied consistently. You can't have one asset as part of development costs that's expensed, another asset that's capitalized. Okay? So let's say that you have two parallel projects that are both doing the same thing. One can't be expensed as part of the development costs, and the other can't be, capitalized. That's the whole idea there. So you have to apply it consistently. So once you actually now wrote up the value of this asset, right? So let's say that you recognize that you're comfortable with it. Now what do you do? Well, at this point now, we have to use either the historical costs method under ASPE, or IFRS gives us a choice between the cost model or the revaluation model. Now, here's kind of a tricky thing. The standards require you to possibly use the revaluation model at your discretion for intangible assets. Now, you can't do it if there's no active market for these assets. Keep in mind, there has to be an active market for you to be able to use the revaluation model. The revaluation model implies that you are constantly keeping these intangible assets at their fair value. Now, when was the last time that you've seen? Can someone give me an example of an intangible asset that they believe has an active market? Can anyone think of one example? Let me actually just pause here. Okay, can anyone think of an intangible asset which can be revalued using an active market? If you can think of such an asset, let me know. Would love to know what your thoughts are here. So please let me know what your thoughts are. Okay, I'll give you 2 minutes, and feel free to state your answer as part of the live chat. Okay, I'll be right back. Okay, welcome back, folks. So there's a lot of really interesting examples here that people have provided. David writes a derivative question mark. A derivative would not actually be an intangible asset. It would be a financial asset. So that wouldn't apply. CJ, you last said in your previous webinar that it's very rare. Yes, I know. But I was just, seeing whether someone has any idea about this. Next, Ahmed says a taxi license. A taxi license. So that's very possible to be a good example. However, I'm not quite sure whether there is an active market for taxi licenses or not. I would assume that that's the case. If there is an active market, then yes. A software license. Interesting. So possibly. However, I'm not aware of a marketplace where you can resell software licenses. Okay, normally when you buy, say, your Microsoft Office license, let's say that you bought Microsoft Office, your license cannot be resold to other people legally. So I would pretty much argue that it's nearly impossible to find a software license that may be licensable to other people. A specific permit that is capable of being resold. Okay, well, give me more, I need something a little bit more here. Mitzi, a customer's list. Well, it's probably illegal for you to sell a customer's list. And then someone is saying a software license cannot be transferred. Well, it depends. It might be transferable if there is a legal contract for it, allowing it. But that's not what I'm asking about here. If you look at what I'm specifically asking about here, right? I'm asking, give me an example of an active market for such a specific license. So, and what you've all kind of seen here by looking at this live chat is that it's pretty hard to think of a active market for intangible assets, and that's usually the case. So a lot of people, I think, struggle with the idea of coming up with this active market, right? And in practice, that's the reason why you generally don't use the revaluation model as part of intangible assets. So if you see it as part of a case, your alarms, bells in your head should be going off like almost immediately, because you might have a client that may be interested in writing up the value of that, but how do you determine whether the fair value of this new idea, might be reasonable or not? Okay, there's a few other examples here. What about carbon credits? I'm not sure that carbon credits have a market value that is constantly changing. I'm not aware of a place where you could buy carbon credits in an open marketplace. Someone saying like a fishing or hunting license. Again, I think that's provided to one person. Another person is saying a transferable building permit for a tower in, say, the city of Toronto. Possible. Okay, now we're kind of getting into something. But again, the whole idea is there might not be an active market for that. Even if it's transferable, that doesn't mean that there's an active market to sell like building permits. You know what I mean? So again, think about what this is actually saying. I think you're all really focused on the idea of transferability, but not necessarily the concept of this active market, right? Like, is there like, an example that I gave previously, is there like an eBay, okay, for lack of a better way to describe it, to sell, building permits? Possibly not, right? Probably not. You probably can't really think of it. The same, and we'll get into PP&E and we'll talk more about that. Chani, what about advertising space on a website? I have to really kind of think about that one. Advertising space on a website. That's a really good question. Why don't we go back and kind of take a look at this? Can you identify it separately? Is it capable of being separated, divided from the entity sold, rented, licensed? Yes. Can you control it? Yes. Can it provide you with future economic benefits? Yes. Okay. Yes. Is there a advertising, space? Possibly. So I actually think that, Channy's example of advertising space on a website might be the first example that I could, use. Okay, so thank you. That's a really good recommendation. David, do you mean being tradable on the Dow or NASDAQ? David, I think you're explaining what is a specific market. I'm not looking for, like a public stock exchange. It could just be a market. Okay, anyway, but I think we kind of get the point, right? Like, I think we're kind of on the same page here. Okay, which brings me to my next point. There is an active market for PP&E, and we'll talk about this in a second. But basically, for property, plant, and equipment, we look for, first of all, identifying all of the costs associated with that capital asset. So anything that's part of the purchase price, other acquisition costs like brokers, commissions, installation costs, architectural, design, engineering, legal, survey, site preparation, freight, anything, okay? Anything that's directly attributable has to be included. If you buy a basket purchase, otherwise known as a group of assets acquired for a single amount, in that case, the cost is determined by allocating the price paid for each basket item based on the relative fair value of each individual item. Okay, pretty simple. And for assets constructed over time, including like direct materials or labor or overhead, you always want to include all of those components directly as part of the overall mix. There's no significant differences between ASPE and the IFRS, with the exception of the borrowing policy, so the interest component. So the specific interest component, the borrowing costs, right? By the way, borrowing costs just means interest, right? Borrowing costs related to acquisition and construction of a qualifying asset. Qualifying meaning one that requires substantial time to get ready for use. That's the main criteria behind qualifying. You don't need to do anything fancy to qualify. It just means that it's like a reasonable, and it must be, capitalized. There's no choice under ASPE. So ASPE says there's a choice. In this case, you don't really have to follow that policy either. If you've got any minor or major upgrades to your property, plant, and equipment, in this case, under 3061, the costs incurred to enhance the service potential would be a betterment and would be capitalized. Now, please note, ASPE uses this term of a betterment. How many of you are comfortable with that term, betterment? Please note that, the betterment award is an ASPE word. It is not an IFRS word. Okay, so when you're doing a case on IFRS, don't use the word betterment. It still means the same thing. A marker is going to kind of understand what you mean, but specifically the word betterment is strictly an ASPE item, right? Like it's not meant to be used as part of an IFRS description. Okay, but basically ASPE looks at, did we increase the physical output or service capacity? Did we lower the cost? Did we extend life, or did we improve quality? Okay, these are the four main areas. If we did, then, we have to capitalize those costs. The cost incurred in the maintenance of a service potential of an item is a repair, simply put. There's no significant differences. However, there's much more detail provided from an IFRS context. So this is the area where IFRS is way more advanced, okay? Way more advanced. Major repairs, overhauls, replacement of parts, major inspections are always capitalized. The replacement components that would be amortized over the useful life of those components. And what's even more interesting, and this is probably the most interesting, to me, is inspections are amortized over the period until the next major inspection. Now, please note, this may not affect you. If inspections happen yearly, that's the same thing as expensing, right? Because then there would be one inspection per year, and even though you are amortizing it, that's almost like writing it off as well. Okay? Does that make sense? It might not necessarily affect you in practice. Now, again, we are back at the choice, right? ASPE only allows the cost model. IFRS all of a sudden allows this cost or revaluation model. Now, all of a sudden, we could possibly use the revaluation model, right? So there is an active market for real estate. There is an active market for the idea, for kind of like your MLS, right? MLS is that market. You can possibly sell real estate in other ways as well, right? So that's kind of the whole idea there. And basically, you would be keeping that asset at fair value minus the accumulated depreciation minus the impairment losses to date. You must be able to reliably measure value, must record at fair value, and must, revalue often enough that the carrying value is not materially different from fair value. And then any decreases in value are recorded in your net income or loss. And any increases go to OCI. Only to the extent that they reverse a previous deficit or a surplus. Depreciation could mean the same thing, by the way, but there is a difference in the way that it's described under ASPE versus IFRS. ASPE says the greater of costless salvage value over the life of asset, or the costless residual value over useful life. IAS 16 says strictly depreciable amount minus cost less residual value over useful life. Okay, only one definition. Componentization. And I know there's a question here. I'll answer it in a second. The cost of an asset is allocated to the individual parts or components when it's practicable. Okay, so basically ASPE says it's a choice up to you to decide whether you want to keep things separate or not. IFRS doesn't say that. IFRS says you have to do it if each individual component is significant in relation to the total cost. So in other words, in say a situation with an airplane, the engine of an airplane might be worth a significant amount of the overall, value of that aircraft. So because it's worth so much, it could be valued separately. Right? So I'm getting a few questions here before we move on to impairment of long-lived assets or capital assets, which is just kind of an extension of topic 3. The first question is, can we capitalize interest on mortgage, building, or land? So remember, yes. So remember ASPE says that there is a choice, right? Based on the qualifying asset terminology for you to either capitalize or not. So it's up to you. And then IFRS says that you must, capitalize the interest expense. It doesn't have to be mortgage expense. So you can't capitalize, the principal portion. It would only be the interest component. Right? So you can't just write off the concept of the mortgage, but strictly the interest component. So forget about the word mortgage. Mortgage is more of like a financial term. It has nothing to really do from an ASPE or IFRS context. Okay. David, is there any terminology difference between residual value and salvage value? That's an interesting question. I would say it depends on your understanding and what the case facts say. There might be from a case fact perspective. Generally speaking, those terms could be used interchangeably, right? But however, the case facts might describe it differently, okay? In general, residual value implies that there is some sort of a residual which is not nil, and salvage value implies that it's worth nothing. However, those two terms could be, again, used interchangeably based on the case facts, David. Topic 4, impairment of long-lived assets. Well, we'll possibly do 1 or 2 topics again, and then we'll take a quick break, and then we'll kind of catch up, okay? 3063, how do you test a asset for recoverability? You test whether there's some, whenever there's changes or events, kind of like a decrease in market price or change in the use or physical condition. IFRS says we must assess at the end of each reporting period whether there's any indication that the asset may be impaired. If such indication exists, we must test for recoverability. Now, regardless of whether there's any indication of impairment, we also must do it annually for intangible assets. Okay, really critical. And annually for goodwill. Okay, so there is a big difference here between ASPE versus IFRS. Also, how do you determine impairment? Again, there is a difference. ASPE says an asset is impaired if the carrying amount is greater than the recoverable amount, and the recoverable under ASPE looks for undiscounted future cash flows from use and then eventual disposition. And if this is the case, then the fair value of the asset is determined, and the asset is written down to the extent that the fair value is lower than the carrying amount. Okay? IFRS says that the asset is impaired if the carrying amount exceeds the recoverable amount, which is defined as the greater of fair value less cost to sell or value in use. Value in use is the present value. It's not the undiscounted future cash flows. It's the discounted future cash flows and eventual disposition of the asset. Now, can someone tell me what do you think they mean by eventual disposition of the asset? So present value of cash flows, and that kind of makes sense. And then the eventual disposition of the asset. And this actually goes back, I think, to David's question. Does that make sense? So what would this be? The residual value. Yeah, got it. Okay. Yeah, exactly. Okay, perfect. Yeah, I just wanted to make sure that we're all on the same page. Okay, perfect. Impairment, we talked about this. Can you reverse an impairment loss? There's no possibility under ASPE. And IFRS says yes for all assets except goodwill. When there has been a change in the estimates used to determine the recoverable amount, i.e. based on the new estimates, the increase goes to your net income statement. Okay? Disposal of long-lived assets. Maybe I'll cover one more topic and then we'll take a quick break. So what's the criterions used for discontinued operations? ASPE says that there's basically 6 main areas. If you want to deem something as a discontinued operation, and we'll talk about how to account for it in a second, but you really need to assess for 6 things to determine whether you truly believe that it's a discontinued operation. Okay, so first of all, management needs to have a committed plan to sell. That's could be like an internal document explaining. The asset or this division is available for immediate sale in the present condition. So, you don't need to fix anything on it before you actually sell it. Management has initiated an active program to locate a buyer, you've possibly hired a real estate agent or a sales agent. The sale is probable and expected to be complete within 1 year. Okay, so, there is some indication, there's some market data. Currently actively marketed at a reasonable price, which, by the way, 4 and 5 could be connected. You can't say that the sale is probable if you jack up the price. And then it's unlikely that the plan will be significantly changed or withdrawn. So changes are still allowed, no question, okay? But no significant changes, and it's unlikely, right? So IFRS says that everything is kind of similar with the exception of number 5. It requires the sale to be highly probable. Okay, so we need to only account for things as discontinued operations if they are guaranteed to happen in that year. The main reason for that is because of the classification of a discount of a discontinued operation. It sits as a current asset. So what is a financial statement impact? ASPE says you measure at the lower of the carrying value or fair value less cost of sell. Your commissions, your legal fees, etc. Also don't amortize it, and you present separately on the balance sheet. Okay, for IFRS 5, for non-current assets, under IFRS, the assets are treated as current assets. But under ASPE, you only do it if you believe the proceeds are realized within a year. And that's really the main difference between this key point here, right? Highly probable versus probable, which may affect your presentation. Because if it's not probable within that year, then it's technically not a current asset under ASPE. Does that make sense? So from that context, you always want to be really careful on how you present. IFRS basically says that it has to be a current asset, right? Because it's highly probable. What happens if there's subsequent increases in fair value? So let's say that you determine something to be worth X number of dollars as part of, you want to sell a building. It's properly identified, disclosed, etc. You've met all the steps, okay? But let's say that building's, goes up in value. Let's say that you are the city of Vancouver, where everything seems to be rising out of control. Well, the value under ASPE would be that the value of the asset is increased and a gain is recognized, and you cannot reverse impairment losses. The gain also cannot exceed of the amount of the loss that was recognized when the asset was written down to fair value less cost of sell. Okay, you can't recognize more than that. IFRS, the value of the asset is increased and a gain is recognized again, but you can reverse impairment losses. And also the gain cannot exceed the amount of the loss that was recognized when the asset was written down to fair value less cost of sell. From a presentation perspective, how do you account for it? ASPE says report the results of your discontinued ops net of tax as a separate element of income and loss. Remember, there's slight differences from a disclosure perspective, right? Where, the losses go to your net income and, the gains go to your OCI, depending if it's ASPE or IFRS. And you would include any losses on the write-downs, and this would never include the accruals of future operating losses from the discontinued operation. What happens if you've changed your mind? Okay, even though you've sworn that it was highly probable, but now you're like, no, I don't want to do that anymore. So ASPE says the assets then are reclassified as held, right? Not held for sale, and used and measured individually at the lower of the carrying amount before it was classified. Basically, what was the original carrying amount before you did all the adjustments? And also you would adjust for depreciation that would have been taken if the asset had not been classified as held for sale. That's pretty simple. So you basically pretend like as if you discounted it, depreciated again for the time that you did not depreciate, right? I think that's pretty simple right there. Or the lower of the fair value. So it might be lower than that. It might be, not as high as you would have immediately, which is why the fair value thing is there. Assets are reclassified under IFRS and used individually at the lower of the carrying amount, again, before it was classified, adjusted for depreciation, or the recoverable amount. It's not the fair value, but the recoverable amount at the date of the decision not to sell, which would be the higher fair value less cost of sell and value in use, which we're looking at present value of future cash flows. Okay, the main reason why we do it this way is because the impairment tests are different under both ASPE and IFRS. And if you look very closely, the impairment test is almost integrated directly into this a part of the platform. Okay, does that make sense? There is almost like a perfect integration for the impairment test itself. Okay. Um, Question: do you have to first determine that the discontinued operation qualifies as a component of the entity? Um, I don't quite understand the question. I don't quite understand the question. So you first have to determine that it could be separately identifiable, right? So in order for it to be a discontinued operation or a discontinued asset, it has to be a separate, a separately identifiable asset. Does that make sense? It has to be totally separate. Okay, why don't we take a quick 2-minute break or maybe 3-minute break? I'll be back at 9:10. Feel free to let me know if there's any questions in the meanwhile. Also, if you haven't done so yet, please print the case that's attached. We'll be talking about it shortly. Okay, thank you so much. We'll see you all soon. Hey folks, sorry for the delay here. So I actually just got an email from someone that was comparing the CPA notes, the Oracle, to what we were talking about today, and just kind of looking at specifically the idea of being a component. So perhaps I should just maybe quickly address that. There's probably other people right now that are thinking the same thing. So what does a component mean from this, the standpoint of the CPA notes, and how does that really affect you? So let me just kind of, first of all, explain what I think you should know. The concept of, first of all, identifying the component is reasonable. Okay, so what we say, and what it means when it reads that we're looking for some sort of a component. Actually, hang on one sec. Sorry, folks. We're experiencing some issues with the connection. Just kind of bear with me here for a sec. Okay, folks, sorry about that. So yeah, sorry, I just wanted to cover the concept of a component just means that it is a separate part of the company, okay? So we are looking for something that could be a separate entity as part of the company, right? So the reason why the Oracle notes will say something like about a component is that it can't just be like, kind of one simple asset. It is actually a separate operating portion as part of your overall kind of operating environment. Okay, folks? So that's really the whole idea there. Any other questions, by the way? Is anyone else experiencing video or audio issues? Let me know. Just want to see whether anyone else is experiencing any. How's the sound quality so far? Or how's the video quality? Now we've moved on to the next slide. I just want to make sure that anyone that was experiencing issues before is no longer seeing those. Okay, is the connection okay for other people? Just want to make sure. Okay, yeah, no, I mean. So some people are saying that the sound is breaking up, and yes, I'm noticing that the connection is not as stable today for some reason. I don't really know. Okay. Oh, it's fine. Okay, perfect. If you feel like there's issues today, feel free to kindly please refresh your screens, okay? Refresh your browsers. You should be able to come right back into it. If you're not seeing what you're supposed to see, kindly refresh, okay? I am getting kind of private messages from people stating that, fix the sound, but I don't think that it's something that a lot of other people are seeing. It could be something that's local. So I do apologize. Okay, next component that I wanted to talk about specifically is government assistance. So ASPE says if you receive any government assistance, the current, if it relates to current expenses, in that case, you would include this in income for the period. And this can be shown either as revenue or netted against the related expense associated with it. For any future expense, you would defer and amortize into income as the related expenses occurred. Okay, so this can either be shown as revenue or netted against the related expenses. Now, for any capital projects, you have a choice to either deduct from the related fixed asset, where you calculate amortization on the net amount, or you defer and amortize into income over the life of the asset. Now, there is a huge difference from an ASPE versus IFRS context. Under IAS 20, the cumulative additional depreciation that would have been recognized to date on the asset would be immediately recognized as income in the current period under IFRS. And if you are transitioning, say, from ASPE to IFRS as part of the case, this would be a huge risk from a case perspective. Absolutely massive risk. How do you accrue a grant receivable for amounts that are not yet received? If there's reasonable assurance that the entity has complied and will continue to comply with all the conditions of the grant, then you can accrue the grant amount, okay? How do you account for forgivable loans treated the same as the grant? You would just recognize in the period the entity becomes entitled to receive it. And this does not explicitly mention the need for reasonable assurance, and the terms for forgiveness will be met. But if circumstances indicate that the repayment will be required, a liability will be recorded. Okay, so it doesn't necessarily force you to do the liability until you know that you actually have to repay it for whatever reason. Under IAS 20, this would be treated as a grant when there's reasonable assurance that the entity will meet the terms of forgiveness. But there's no idea behind this, recording of the liability. We almost assume that that's the case. How do you account for repayable government assistance? In this case, it's accounted for prospectively when circumstances arise that indicate, repayment will be required. If it was originally recorded in income or netted against expenses, we credit the liability and then debit the expense in the period when circumstances indicate repayment is required. If it was originally netted against the cost of the capital asset, then we increase the cost of the asset by the amount of the assistance that is repayable and then amortize the revised cost over the remaining life. IAS 20 is a little different. If it was originally recorded in income or netted against expenses, you credit a liability and debit the expense in the period when circumstances indicate repayment. If it was originally netted against the cost of the capital asset, right, if we took it away originally, the cost of the asset is increased, and again, the cumulative additional depreciation that would have been recognized is immediately booked, which could be a huge amount. Next portion, I think a lot of people are very scared of, okay? I think a lot of people are extremely scared of this. What is the definition of control, right? So we're going to talk about major investments, joint ventures, etc. 1582 talks about the control idea. Basically, control means the continuing ability or power to determine the actuary's strategic, operational, investing, and financing policies without the cooperation of others. Okay, so basically that's the main definition, the way that it's described as part of the ASPE standard. There are also factors for you to consider: the relative voting rights, the composition of the board, the ability to dominate management, and contractual arrangements. These are all potential, instances where it might be the case for control, or it might kind of give you an idea, behind what might be deemed a control. IFRS 10, which is the equivalent standard, says something a little bit different. We're talking more about exposure. So investors are exposed or has rights to variable returns from its involvement with the investee and has the ability to affect these returns over the power. Okay? So it's not the continuing power for the actuary. We're strictly looking from an investment perspective, which is a slightly different way of looking at it. Now, how do you account for a consolidation? You can either choose the consolidation, equity, or cost method unless the subsidiary shares are quoted within an active market, which in this case you would use fair value. And all of your subs, right, before consolidation must be accounted for using the same methodology. There's no significant differences, but most would consolidate. How do you calculate goodwill? So goodwill really is the excess between the fair value, or actually I guess your consideration paid minus the fair value of 100% of the identifiable assets and liabilities. And then non-controlling interests, known as NCI, NCI is measured at the fair value and basically a component that does not relate to what you did not buy. Okay, so it's the point that I guess it's sort of the part that would be omitted. In calculating the fair value of the intangible assets acquired, an intangible asset should be recognized separately from goodwill when they result from contractual or other legal rights, or they're capable of being separated and sold, licensed, whatever, separately. How do you value a bargain purchase option? A BPO is an opportunity for you to buy for less than the combination of the assets worth individually. In this case, it's almost like a negative goodwill. Okay, so you didn't overpay, you underpaid. We first assess whether the acquirer has correctly identified, potentially. And then if the premium still exists, right, if you still bought it for less than what they're worth, then the acquirer would recognize the resulting gain directly in your net income on the acquisition date. What is significant influence then? Is there any differences there? 3051 tells us that significant influence is the power to participate in financial or operating policy decisions. We generally look for about 20% or more. It is assumed to be, of a significant influence unless you prove otherwise. So in most cases, you would use the idea. Other indicators other than 20% could be representation on the board of directors. But again, we kind of be looking for 20% or more. Participation in policymaking processes. So how many of these do you control? Right? Material transactions. Are you the only, say, client or supplier? Interchange of managerial personnel. Do some of the managers also work for you? Right? Do you control their salaries? And the provision of essential technical information, such as patents and trademarks. In this case, we would account for using the cost or equity method unless the investee shares are actively traded, in which case the choice is fair value or equity method. However, IFRS only allows for the equity method. So what is this equity method? Okay. And by the way, there is a slight difference. Of course there is. There is an equity method under both ASPE and IFRS. Here's how it differs. ASPE says that the investor basically, as part of the equity method, must recognize almost like a percentage share of the investee, and then the unrealized intercompany gains and losses would be eliminated. And it would reflect the original cost, the income, the cumulative income, the proportionate share of dividends and changes, okay, or corrections or capital transactions, etc. You also have to adjust for for reporting period, differences and changes. That's critical. There's no significant differences or changes other than the investor picking up their share of comprehensive income and presenting it separately, okay? Because OCI does not exist under ASPE. OCI is strictly an IFRS concept. Also, ASPE requires differences in reporting periods to be disclosed, but would be limited to 3 months. Joint ventures. I think a lot of people are really scared of, JVs. ASPE looks at really 3 methods: the cost method, the equity method, and the proportionate consolidation. You kind of understand cost and equity method now. I've covered them. But the proportionate consolidation is a pro rata share of all assets, liabilities, revenues on a line-by-line basis, and then combined with similar items in the investor's financial statements. Okay, ASPE also says we must treat all JVs consistently. Now, keep in mind, IFRS says from this context, joint arrangement, we first arrive at a concept of joint arrangements, which would be divided into joint operations. So a joint operation is not separately incorporated. Basically, think of a joint operation as a partnership, and then a joint venture, which is separately incorporated, for which you would use the equity method for. and the proportionate consolidation would be more for the partnership and joint operation. Now, how do you recognize gains and losses? Generally, ASPE says, yes, you could recognize gains and losses, but only to the extent of the other non-related ventures interest. Okay, the gain can be taken into income immediately, only to the extent that the cash and other assets are received as consideration. And otherwise, the gain is deferred and amortized into income on a reasonable basis over the life of the contributed assets. Losses on contributions to a joint venture are recognized in income immediately to the extent of the other venture's interest. Okay, IFRS 11 says, yes, also you can recognize gains and losses, but only to the extent of the other non-related venture's interests. And the losses on contribution to a joint venture are recognized in income immediately to the extent of the venture's interest. Okay, similar. Inventories. So don't worry, folks, we've got a few more to go, and we're going to be done rather quickly, and then we'll transition into the case. Inventories. So what, first of all, is allocated or included to inventories? 3031 says all costs incurred to bring inventory to the present location and condition included. All direct costs, labor, materials, overhead, fixed and variable, you must allocate. And then borrowing costs, remember, are a choice, right? So the borrowing costs are your interest component. You could include, but you don't have to on, like under ASPE. And that's, by the way, that's more of like a entire firm type of a decision. So if you include borrowing costs as part of inventory, you must include them in other accounts. Does that make sense? You can't choose to ignore the inclusion of borrowing costs in other accounts if you choose to, include it in one of the accounts. IFRS says that everything is very similar except borrowing costs must be included. There's no longer a choice. There's also a few costs that should not be included as part of inventory: abnormal waste, storage, overhead, or selling, like admin. You must use FIFO or weighted average. There's no differences there. And now we move into topic number 9. You'll notice that we kind of sorted things from the standpoint of how often they may appear as part of a professional exam context. So now we're moving into topics that I would say that are probably a little bit more obscure. Now, any questions up to this point? Any questions at all? Does anyone have any questions whatsoever up to this point? Okay, wonderful. Okay, great. So non-monetary assets or non-monetary transactions. So non-monetary transactions would be measured at the carrying amount under ASPE 3831, not the fair value if any of the following is met. If the exchange lacks commercial substance, so if you exchange one asset for another, but it is not expected to, bring you additional cash flows, okay? That's what commercial substance means. Commercial substance means future cash flows will be changing. So if the exchange lacks commercial substance means, you've traded assets, but as a result of that trade, you have no expectation of changes to your cash flows, then you cannot measure at the carrying amount. You have to. I may have just kind of read this backwards, and it didn't sound right to me. It would be measured at the carrying amount in that case, but not the fair value amount. Okay, because it's basically the same asset being exchanged. Also, the carrying amount is used if neither the fair value of asset given up or received is reliably measurable. If the exchange of inventory for other inventory, insignificant differences, different lines of business occurs, or if this is part of some sort of a spin-off or a liquidation. Non-monetary transactions as part of IFRS are recorded in a different way. If it's measured at the carrying amount, we're looking for exchange lacking commercial substance. Again, no changes to your cash flows. Or neither the fair value of asset given up or received is reliably measurable. Arm's length versus non-arm's length. We must apply related party rules. So in order to record fair value, we need to it be in the normal course of operations. And if it's not, but there's substantial change in ownership and the exchange amount is supported by independent evidence, we could still recognize it as fair value. Now, there's no specific guidance because IFRS doesn't really focus on the related party disclosures. How do you determine fair value? So ASPE says more reliably measurable of fair value of asset given up or received. If you feel like they're both equal, then use the asset that's given up. Okay. IFRS says when dissimilar goods or services are swapped, the revenue is measured at the fair value of goods or services, adjusted by any cash payments. And again, if you can't, kind of determine, look at the fair value of what is given up. Related party transactions. This is just going to be a quick, discussion. Again, we already covered this. I just wanted to quickly remind you of that. And now we're going to jump into leases, which I think are quite different from an ASPE versus IFRS context. So the main differences from an ASPE context would be that ASPE looks at at explaining the difference between a basic operating or a capital lease by looking at reasonable assurance of ownership transfer, or the lease term being 75% or more of the economic life, the present value of minimum lease payments being 90% or more. We look for these numerical adjustments, okay? From an IFRS context, we look for other things. We look for ownership transferring, we look for bargain purchase option, and we look for qualitative ways of describing. So major part of the economic life, present value amounting to substantially all the fair value. So we're not necessarily tied to 90% or 89% or 91%. We look at it from a qualitative context. So what that means is an asset might be capital in more cases as part of IFRS compared to ASPE, right? Think of the concept of the 89%. 89% might still be operating under ASPE, but one may argue that 89% is substantially all of the fair value of the leased asset. Does that make sense? Something for you to really take a look at and focus on. Lessee's treatment. So if you're the lessee under ASPE, you record capital assets as an asset and the obligation, right? The liability at the present value of your minimum lease payments. The discount rate is the lower of the rate implicit in the lease or the incremental borrowing rate usually provided to you. Subsequently, lessee would amortize the asset over the lease term. Okay, so you have to amortize it. Or if there's a BPO, you'd want to do it over the entire life of the asset. And you would split the loan payments between the liability reduction and the interest expense. Any indirect costs would be expensed. From an operating lease context, we would just pay payments, right? From an IFRS perspective, if the discount rate is not identified, if it's not the rate implicit in the lease, then it's the incremental borrowing rate, but not the lower of. And if the ownership is not expected to transfer, then you use the shorter of the lease term and the useful life. Okay, now the expectation under ASPE is that you just generally use the lease term, okay, but not the shorter of. It could mean the same thing, just more data as part of IFRS. And the initial direct costs would be added to the asset, right? Not expensed immediately. They would be capitalized. The lessor either records it as a sales type or direct financing lease. This is assuming that it's a capital lease in nature, right? And we're looking at recording it as a sale, right? And hopefully there's some sort of a profit component. That's what that would be. Direct financing lease is usually a financial institution or a leasing company where strictly they make money off the interest component. And if at the time of sale, the leaseback carrying amount is less than the fair value, you would recognize the loss immediately. There are no significant differences except that IFRS does not actually label leases as sales type or direct financing. And for manufacturer and dealer leases, the revenue would be the present value of minimum lease payments discounted at the rate implicit within the lease. I'm not going to get into too much about sale leaseback transactions, but basically what they are is the idea that you would sell something and then immediately lease it back. So you would still use the same criteria to determine whether, you're part of a capital or an operating lease. If you're part of a capital lease, then you would defer profit and loss and amortize in proportion to the amortization of the leased asset. If it's an operating lease, then you defer profit and loss and amortize in a proportion to the rental payments. Now, exception is under ASPE if the seller lessee retains more than a minor portion, but less than substantially all. Okay, so if you've basically bought a portion of it, some of the gain may be recognized up front. And by the way, impairment is if fair value is less than carrying amount and measured as a loss immediately. IAS 17, we first use the criteria to determine if it's capital or operating, and then under a finance lease, we would look at, recognizing profit and loss over the lease term. Operating lease, we would recognize the profit and loss immediately, okay? Which is very different, by the way. Take a look. It's very different than ASPE. Unless the sale price is less than fair market value, or if it's greater, then you would defer and amortize. That's just the key consideration. Lease inducements. What lease inducements are, if someone offers you a really good rate and says, if you lease something from me today, I will give you 2 free months. Well, there's no such thing like as a free lunch, and accountants will burst your bubble and say, well, that's possibly not the right approach here. So lease inducements are recognized as an offset to rent expense evenly over the lease. If the free rent is at the beginning, the lessee would then debit rent expense and credit a liability. If it's at the end, you debit rent expense and lease inducement asset and credit cash. And by the end, they will be equal. There's no significant differences other than some profit is allowed immediately for lessors. ASPE says that you can, in the initial measurement of the lease, it can be included. ASPE says for sales type to be expensed at the beginning and for finance leases to be expensed and offset by an equal amount of unearned income in your P&L. Contingencies. Do you recognize or accrue contingencies? 3290 says it can be accrued if it's likely, right? And estimated. If it's one of the two, then you probably just want to add a note. And IFRS says it should be accrued if it's probable, so more likely than not, possibly a lower definition of what is quote-unquote likely. So keep in mind, there is a big difference here in terms of wording. Likely is not the same thing as probable. Okay? And then any liabilities not meeting the above conditions would be disclosed. Contingent gains, both ASPE and IFRS, you cannot recognize any contingent gains, and that could be like, the chance of you potentially winning a lawsuit. Can't do that. Then under ASPE, we would disclose if the gain is likely and also disclose whether the gain is not determinable. Okay. IFRS says only if the gain is probable. So again, ASPE has a higher threshold than probable. It's likely. Any change in your contingent liability, timing, or amount is treated as a change in estimate. Okay. And any future event will likely to have to confirm a gain would be disclosed. If there's a range, by the way, this is an interesting part of the question. If there's some sort of a range as part of contingent gains or losses, if you've got a range, then you take the lower amount of the gain under ASPE or the middle point as part of IFRS. Foreign currency transactions and foreign subs. I'm not going to spend too much time here, but it is possible for you to just kind of be tested on here. ASPE says that the current rate method is used for self-sustaining subs, and the current rate method is used for operations with a functional currency different from the reporting currency. What is the current rate method? We translate all assets and liabilities at the current rate. We translate revenues and expenses based on the average. And gains and losses on transaction are recognized as a separate component of shareholders' equity because there's no OCI under ASPE. Right? And that's the main difference between ASPE and IFRS there. Should you use the temporal method for subs? So the temporal method is used for integrated subs. We translate money at the current rate, assets, liabilities at the historical rate, revenues at the average rate, and gains and losses translated and recognized into income. Same method applies to both. Now, how to use this from a case writing perspective? We're going to take a look at kind of some basic formats. So now that we've identified that we've covered a lot of these ASPE versus IFRS subjects, a lot of you struggle specifically with how to apply this to a case framework. So we would obviously look for some sort of a wrongly recorded accounting transaction. Criteria would be the key for success. Try to identify really why something is wrong or right. And you would use this kind of a format. This is the first part of the format. When you are writing an answer, try to identify it. Try to analyze it. Explain what is the correct treatment. Are there any alternatives? Right? Think of the journal entry and the possible criteria. Think of a way to recommend and conclude. And then consider impact on other areas or perhaps tie in other competency area topics that you think would be relevant for that context. Okay? Now let's actually quickly take a look at the case that we've identified. We'll just quickly read it and we'll be able to see if we can, kind of work on it together here. Okay, folks, I know that we're kind of running out of time. We might take a few extra minutes here tonight, but I just wanted to quickly identify things and we'll talk about them. Okay. So as you spot accounting issues, please let me know. Okay. Please let me know what your thoughts are. And I'm happy to discuss them with you and, let me know kind of what you end up with. Okay. So why don't we just kind of start off, with this kind of right away here. Okay. So can anyone see my screen? Yeah, you can see this. I'm just going to draw a little happy face. This is me. Okay, this is Mike. That's me. Okay, wonderful. So why don't we get started? Long-haul trucking, LHT, is a transportation business that operates a fleet of long-haul trucks transporting goods. LHT has one wholly owned subsidiary, Fix Inc., FFI, a full-service mechanic shop that maintains a fleet of LHT, and also has outside contracts for the maintenance of other companies' fleets. LHT is a private company with a June 30th year end. Okay. So right off the bat, when we see a private company, we immediately think of ASPE. But in this case, we're being told that the company is owned by private equity investors and reports under IFRS. So I would say this is kind of unusual, and that's mainly the reason why I picked this case. Because a private company doesn't mean that it's always going to be the context of ASPE, if they specifically identified. But let's see why this might be the case. So it is now September, right? And again, we have this June 30th year end. You're a CPA, okay? You're an audit senior. So your role, right? I like to always highlight the role. Auditor. Okay, you're an audit senior. And LHT has been a client of your firm for a number of years. LHT has engaged your firm, and it has done in the past for an audit. So right off the bat, we see that the first AO is probably going to be, some sort of an audit discussion. The company's bank has an annual audit requirement as part of the condition of the loan. And you're beginning the audit. The comments are found in Exhibit 1. Okay, so, here we have kind of a description of the user, right? The partner on the engagement asked you to send them a memo discussing any accounting issues. So maybe I'm going to say that, this is probably the first assessment opportunity that's clear, right? So you might actually say that possibly this was the first part of the audit, but it wasn't really a clear assessment opportunity. It wasn't a clear required. So I'm just going to say here that I feel like this is the first AO, right? Which is a financial reporting. So because this is an ASPE versus IFRS webinar, and by the way, we have tons of webinars, so feel free to check out others. But we're only going to focus on financial reporting issues. Okay, I do apologize. I know that there's other things which we can, perhaps kind of talk about. But as we read the next little bit here, kindly let me know if you feel like there's, accounting issues here. Okay, so please identify the accounting issues as I read them out, and feel free to tell me what you think they are. Okay, so let's read Exhibit 1 and we'll kind of get started here. So it's been hectic getting ready for the audit, finalizing the disposal of our subsidiary, FFI. Okay. So the board of directors decided to sell FFI because it hasn't been as profitable as LHT owners required. LHT wants to again focus on the transportation business to increase its market share. In that more profitable industry. I've been very busy with due diligence requests from the purchaser. FFI made up nearly a third of our operations, so there's been a lot of requests. I'm sorry if audit papers are not as good. I've drafted financial statements, blah, 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 tax working papers. Can you take a look at these? So basically here we have other AOs, right? I'm going to call this AO2, assurance. AO3, tax. Okay, taxes, income payable, yada, yada, yada. LHT really needs to finish the audit on time because we've made a few adjustments. Late payments on our loan indicated the bank had indicated it is not willing to forgive any more late payments. Thankfully, we met our debt covenant. Okay, so you might kind of really know here that basically this is possibly AO4, the debt covenant. Interest coverage ratio of 10, because otherwise the loan becomes repayable, right? And really that's why you're being asked to, construct this audit, right? Or conduct the audit. So we've hired an outside fleet company to do some work on, like on our trucks. We're selling FFI soon. We wanted to try the outside company out. They said that it was regular maintenance work. We felt it should be capitalized because $90,000 is an abnormal amount of work and obviously means that the trucks weren't up to par. Okay. So I would say this is probably issue number 1 over here. Okay, I'm going to call this number 1. And I'm going to call this number 2. Okay, we're going to talk about them in a second. We've been subject to a new government legislated transportation levy. We've driven a specific amount, some other information. You might want to discuss whether you feel like the levy should be accounted for or not, right? We haven't recorded the expense. So I'm going to say that this is probably number 3. We've obtained a new contract from Bittersweet. The date that we received our first payment, they wanted exclusive rights to 2 trucks and drivers to incorporate them into their fleet. They approach us because we have acquired new refrigerated trucks they want to use. The trucks are hard to come by because of long lead times, and they're very costly, about $275,000 each. Since we can cover our regular deliveries using other trucks, Bittersweet Co. is willing to lease the trucks for a total of $8,000 a month, implicit rate of 8%. Okay, so $8,000 a month, original price of $275, 8% per year, 5-year contract. These are all the terms that you really need here. Unexpected services, almost $500,000 of revenue recorded. And also, we might be able to sell these 2 trucks to Bittersweet Co. prior to the end of their useful lives, which is 8 years, right? For $114,000 each. And that's the estimated fair market value. So I would say that's number 4, right? This is the lease component. If we keep reading here, like I said, we've been working so hard because we're about to close on the sale of FFI. We have an offer of $5 million for shares. Okay, so some other stuff here, overhead expenses, blah 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 blah. When a client went out of business, and there's maybe some minor stuff here. Some note disclosure about some write-offs, but I would say it's probably not as significant. And we just kind of keep looking. Here's the discontinued op. Right, it is presented separately, as you can see here. You might want to decide whether that's reasonable or not. Okay, does anyone see any other accounting issues other than the ones that I've identified so far? Now, by the way, does everyone see the 4 accounting issues that we've talked about? Does everyone see these? So basically, there's 4 accounting issues thus far, right? I believe that there's really 4 concrete ones that you kind of have to know and see here. Right, folks? Now, who can tell me what these 4 issues are? If you can number them, if you can name them, if you can put them directly into the live chat, tell me what they are. Okay, let me know. I'll give you 2 minutes. Feel free to let me know what they are. Okay, so I'm getting a number of answers here, folks, so I'm just going to quickly take a look at it. Someone writes, number one is an operational issue. It is definitely not an operational issue, okay? So remember, we talked a lot about, selling off a subsidiary. It is certainly not an operational issue, okay? So that to me means that you were not paying attention to the webinar because we talked about discontinued ops, and this is a clear discontinued operation. Next is, number two would be PP&E, right? Whether we want to record this as major work or minor work because of the, relative nature. Is it a betterment, right? Like the concept from IFRS, is there something that's major? Is it extending the useful life or not? That's, what we'd want to include. Number three would be a liability. So it is some sort of a contingent liability. Is it measurable? Is it likely? Yes. So we have to record. And number four specifically, would be a lease. Okay. It's just simply a lease for you to be able to identify, decide whether it's a capital lease or a operating lease as part of it. And by the way, it is a sale leaseback transaction. Now take a look at this completely random case. Out of 4 accounting issues that we've identified on this page, all of these 4 items were covered as part of the webinar. It's no secret that the ASPE versus IFRS webinar was specifically focusing on the most tested areas. And just to show you that you don't really need to, spend all this time trying to review random standards like operating segments. I hate to pick on operating segments because I recently taught them. But, there's so many important standards as part of the handbook. The point that I wanted to make here, and we are running out of time, really unfortunately here, but the point that I really wanted to make here is try to focus on the most common areas and know them inside and out. Okay? So for the first part here, I would want to go through the criteria and to determine whether the 6 points were actually met or not. Remember, we have to make sure and we have to go through the criteria to really assess whether that's the case or not. You would have to very clearly document whether you feel like that's a possibility or not. The next kind of issue that I think is really important because of the amount of money that's associated. Remember, you always have to rank, folks. So this is probably the most important issue right here, right? That discontinued op. And this is probably the second most important issue. I would say that, you'd want to discuss whether that's a, operating or whether that's a finance lease. And you'd want to look at the specific inputs, right? The 8%, right? The 5 years, divided by, 8. And then you have to really identify whether you, believe that this is an operating or a capital lease. And, when you do the math, you might notice that this is actually an operating lease. What do you know? Okay. So you'd want to explain exactly how it's treated. So at that point, you would want to recognize the reversal of the $480,000 sale. And, you can kind of work out some of these numbers. The next issue that I would cover is probably the truck maintenance. And then you might want to see whether you feel like it would actually be, increasing the value. Now, just because someone charged you a lot of money doesn't mean that it was, an increase to their, to the overall useful life of the truck. It literally said this was just regular maintenance work. So this is not something that would increase the value of the truck. So maintenance might be expensive, but that doesn't make it all of a sudden like something that would extend the life of the asset. So everything has to be put into context. In this case, it's probably not an extension, and this should strictly be an expense. Okay? So they say that it should be capitalized, but you're not supposed to capitalize regular maintenance work. So that's an issue, right? You're supposed to just strictly expense it right away. And last but not least, the concept of a liability, right? Basically, do we owe them this money? We kind of look for, do we think it's likely? Do we think it's measurable? It's clearly that there's some sort of an obligation, right? And it's very reasonable to assume that you'll be using these trucks for more than 500,000 kilometers. So if that's the case, then you probably have some sort of a liability. But at this point, because you haven't really breached the threshold, you probably can't really record it just yet. There were a bunch of other issues here. You could have talked about debt and, how do you classify debt, especially if you feel like there is a breach. So later on, if you did go through it, but that'd be kind of a really good starting point. I highly recommend for all of you to at least try to write this case as well. And try to attempt it and then debrief it. It might be a really good starting point. And that's pretty much it. Okay, so thanks for checking out the most covered ASPE and IFRS standards. This has been great. Here's a little bit more information about PEP formula, about some of our programs. Also, please check out our future webinars. If you have any questions about the material, please don't hesitate to contact me. Here's my direct email, my direct phone number. Feel free to get in contact. I've also uploaded the specific standard, PDF online. I've actually modified it several times, so feel free to just download the most recent version online now. And also, you can also download the question along with the answer for your attempt, later on. And feel free to also attempt it and, try it out and see if you can practice it. I think that there was a lot of really good information here. I think you should practice writing it. Even if you kind of know the information, it's just helpful to at least try to put it down on paper. Okay? So one last thing that I wanted to mention, many of you may know that the webinars are included for registered students. We will be, in addition to what you're seeing here, we will be increasing the number of webinars. One of the key kind of considerations that we're going through today is we are possibly bringing on another instructor sometime in late August to teach 3 webinars a week instead of 2. It's something that we're exploring. It hasn't been finalized, but we will be posting a new webinar schedule. And the reason why we sort of haven't is because we're trying to, understand and figure out and, determine kind of how we go about doing that. One of the considerations that we're going through is we need a lot more people to participate in the webinars for that to be affordable for us. So would greatly appreciate if you could spread the word amongst your friends about these webinars and try to encourage them to also attend and join the program. Okay. Again, thank you all so much. I hope you all have a wonderful evening. I will post the annotated version of this question as well. If you need it or if you need anything else, feel free to get in contact, with me. Again, thank you all so much for attending tonight and have a wonderful evening. Take care. Bye-bye.